Okay, let's just get right into it. Welcome to today's Explainer, where we're unpacking a financial disclosure that honestly has Wall Street doing a massive double take. We're talking about President Donald Trump's investment accounts, which just revealed a colossal stock portfolio shakeup. Now, if you just glance at the headlines, it sounds like he just picked a few new stocks. But as we dig into this August 22nd disclosure regarding the portfolio rotation, we're going to find out that the reality is vastly more complicated. And honestly, infinitely more fascinating. Just wrap your head around this number, 1,051. That is the exact number of securities transactions executed by these accounts in just the single month of June. We're talking about more than 550 individual purchases and over 450 sales, all crammed into a 30-day window. For literally any standard investor out there, that level of activity is just mind-boggling. And the sheer scale of the capital moving around, it's just as staggering. The total disclosed value of these June transactions ranged from $78.1 million on the absolute low end up to a whopping $263.1 million at the max. Now, government financial disclosures, they only provide transaction ranges rather than exact to the penny amounts, which is why we've got the spread. But look, regardless of where the final number falls in that range, we are witnessing a massive, high-volume rotation of assets here.
So this brings up the absolutely crucial question. How do we actually interpret this? Is this flurry of activity a bullish signal for the stocks they bought? Is it some sort of dire market warning for the ones they sold? Or is there something entirely different happening just beneath the surface? Today, I really want to challenge us to look past all the noisy political headlines and actually analyze the underlying financial reality of these specific trades.
So how does this actually play out? Here's a really rapid summary of the highest profile actions from the disclosure. On the buy side, we're seeing major acquisitions of Berkshire Hathaway, Visa, Mastercard, Home Depot, and Cintas. And on the flip side, the accounts were actively shedding names like Meta Platforms, Motorola Solutions, CME Group, and McDonald's. Are you noticing a theme here? The portfolio clearly favored really established cash-generating American businesses while actively trimming off some of the tech and growth names. Now, what's super fascinating to me is the very first big buy on that list, Berkshire Hathaway. Right in the middle of the month, on June 18th, the accounts bought somewhere between $1 million and $5 million of Berkshire. This isn't just some speculative bet on a trendy tech stock, right? Berkshire Hathaway gives you exposure to insurance, railroads, utilities, energy, plus a massive publicly traded equity portfolio. It's essentially a highly defensive, incredibly diversified operating company portfolio all on its own. And this brilliantly illustrates the underlying strategy when we look at the dual purchases of Visa and Mastercard. The accounts bought at least $1 million of each. These two companies represent a very specific structural bet. They aren't traditional banks. They don't lend money and take on heavy credit risks. Instead, they are quite literally the global financial infrastructure. So buying both of them is basically a macro-level bet on the long-term structural migration to digital payments and consumer spending, rather than just a narrow bet on a single company. But hold on, let's do a quick pattern interrupt here and talk about the headline that generated the most sensational buzz, the so-called Meta sell-off. The disclosure showed that the portfolio sold between $1 million and $5 million of Meta on June 18th. And naturally, the initial headlines instantly suggested that the portfolio was completely dumping the stock. But there is a huge catch here. The catch is that the accounts actually turned right around and bought smaller amounts of Meta later in June. So it wasn't a total abandonment at all. It was just a position reduction. Meta, as we know, is investing incredibly aggressively in AI, creating this fascinating contradiction where it can be simultaneously expensive, but also extremely profitable. So as smart investors, you've got to weigh Meta's AI investments against its valuation. You really cannot just follow a headline that screams sold without stepping back and asking what the company's future earnings are actually worth today. Now, if you thought the Meta situation was a bit of a roller coaster, check out this highly complex timeline for Palantir. On June 3rd, the accounts bought a small amount. On June 16th, they sold up to $50K. Then on June 18th, bam, a massive sale of between $500,000 and $1 million. But wait, on June 23rd and 24th, they bought it again. What makes this juxtaposition so intensely fascinating is that those massive sales occurred just days after the reported June 14th U.S.-Iran peace agreement. Which brings us to a really vital rule of financial analysis. Trade timing does not prove motive. Look, because the account owner is a sitting president, these trades occurring around highly sensitive geopolitical events instantly triggered ethics questions. But as impartial analysts of this source material, we have to recognize that we absolutely cannot turn speculation into fact. We know what was traded, but establishing exactly why it was traded on those specific days, well, that requires us to look much deeper into how these specific accounts actually function. And that brings us to the real core revelation of today's explainer. We have to take a pretty drastic pivot here and ask a deeply practical question. How on earth could a single investor possibly manage 1,051 highly specific trades, ranging from tech stocks to Vanguard ETFs, in a single month? I mean, unless they literally didn't sleep for 30 days straight and survived purely on espresso, it just doesn't add up. Well, here is the definitive answer. Coming directly from the White House, they stated that these accounts are, and I quote, independently managed through discretionary accounts and computer-based portfolios designed to replicate recognized indexes. So the crucial takeaway is this: Donald Trump and his family do not direct these individual trades. And honestly, this completely 100% changes the narrative of the whole portfolio shakeup. There is no one sitting at a desk handpicking 1,000 trades a month. What we are actually looking at here is an automated investment strategy. In practical everyday terms, this is a computer-based system that uses highly complex algorithms for direct indexing and tax loss harvesting. To maintain broad diversification and simultaneously optimize for taxes, these algorithms will automatically generate hundreds, if not thousands, of buys and sells without a single drop of human intervention. This perfectly explains why an account would randomly sell Meta on the 18th and buy it back a few days later, or trade Palantir 4 different times in 3 weeks. Just to really solidify this revelation, let's zoom out to this absolute jaw-dropper of a figure, 21,000. Trump's accounts made over 21,000 securities trades in the year 2025 alone, with total values ranging between roughly $600 million and $1.86 billion. I mean, this proves beyond a shadow of a doubt that June wasn't just some isolated, politically motivated stock-picking spree. It's simply part of an ongoing, machine-driven, algorithmic pattern. So, knowing that a computer is more than likely pulling the strings here, let's take a look at the ultimate investor scorecard, completely stripping away all that political noise. If we evaluate the fundamental business merits, you get a way clearer picture. Take Berkshire, for example. It offers fantastic diversification, though you obviously have to watch out for succession and valuation risks, making it a pretty solid buy or hold. Then you've got Visa and Mastercard. Their incredible global payment moats also land them comfortably in buy/hold territory. Meta, on the other hand, boasts a huge user base and tremendous AI potential, but its heavy AI spending means it's more of a hold or buy, strictly depending on where you sit with its valuation. And finally, Palantir has some super impressive software growth, but its very high valuation currently makes it a watch rather than an immediate buy. Which brings us to the primary educational takeaway of this entire analysis. And it's a simple one. Don't copy this portfolio. A government financial disclosure gives us a window into transactions, sure, but it does not give us the investment thesis behind them. Smart investors don't blindly attempt to mimic a high-profile, algorithmically driven disclosure. Instead, what do? They study the business, they study earnings, they study cash flow, and they study fundamental valuation. And I really want to leave you with this final provocative thought to mull over today. When you see a headline about a famous figure or a politician making a massive market move, the biggest question isn't, what did they buy? The real question is, would you still want to own the stock if they had never bought it in the first place? If your answer is yes, based on your own solid fundamental research, well, then you have a real investment thesis. But if your answer is no, you're probably just following a headline. Thank you so much for joining me on this explainer today. Keep studying those fundamentals, and I'll catch you next time.